Welcome to the PRT Pod. I'm joined here with Jon Loach, Origination and Execution Director within PRT, and Mark Johnson, Head of Institutional Clients within our Asset Management division. Today we'll be discussing Endgame Insights, what they are, how they vary scheme to scheme. But before we get to that, please can I invite you guys to introduce yourself. Mark, would you like to go first?
Hi, Roshni. I'm Mark Johnson. I'm responsible for institutional clients at Elgin.
Hi, Roshni. Jon Loach from the institutional retirement side of the business, and I help pension schemes with buy-ins and buyouts.
Great, thank you. And thank you both for being here. We'll kick off straight into the questions. So I guess firstly, in sort of a pensions perspective, what would you say Endgame actually is?
Thank you, Roshni. Well, Endgame refers to the final phase of a pension scheme's life cycle, where the focus shifts to securing members' benefits and passing them on to an insurer, or running on, perhaps on a low dependency basis, so relying less on the sponsor.
Great. And I guess we know that pension scheme funding levels are currently at an all-time high following the surge in bond yields in 2022. What would you say this actually means for the scheme?
Well, I think the first thing that they need to recognise is that they're in a much better position than they had been previously, and to ensure that that situation doesn't reverse. So to effectively lock down the gains that they've made, and they can do that through various hedging strategies, and then to consider what those next steps are going to look like in terms of their end game strategy. And that could include, conversations with the sponsor, that it could include looking at some of the assets that they hold on their balance sheet and wondering what they might want to do with those, whether they want to go and talk to an insurer or not. So there's a range of considerations that need to start as early as possible if they're going to get the best outcome for members.
Echo what Mark says. I think the previously schemes were considering the affordability of buy-ins and buyouts. I think now affordability is less of a headwind, but the focus is on preparation as to when the time is right for that scheme and what they need to do to get there. The focus is on illiquid assets, surplus, and a few of the other topics I'm sure we'll consider.
Great. And I guess whether schemes choose to buy out or run on as part of their sort of end game is quite a topical debate right now. How should schemes navigate this?
Well, it was interesting last week listening to the Chancellor making the Mansion House comments that she did, and a number of commentators in the industry wondered whether there'd be mention of scheme surplus and the ability to extract. And we understand that those pronouncements are going to wait until next year. So last week was very much focused on local government and DC. But clearly there is a narrative emerging in the marketplace, which is to say, if I have a surplus, can I extract it? Can I use it perhaps to uplift member benefits, or perhaps return some of that to the sponsor? So I think people are, in some instances, waiting to see how the government responds to those various conversations. There's a significant amount of money sitting now behind FTSE 350 schemes that is in surplus and that could be used to the advantage of the members. So I think the schemes that we talk to are considering their next steps, and one of them could be to engage with an insurer, and the other could be to run on for a while before perhaps engaging with an insurer at a later date and time.
And what would you say are the sort of like pros and cons of either, buyout or running on, at least in the sort of interim?
So I think that in terms of pros and cons, I think every scheme is different, and there'll be different objectives for companies and trustees. It will come down to the covenant of the sponsor, their future plans, but also the position of the trustees and securing the members' benefits. Key will be in terms of that security, the member experience, but also for the company, it might be that they want to focus on their main business and dispense the liabilities from their balance sheet.
So if a scheme is, fully funded, but they're currently running on, why might they not choose to go to buyout just yet?
A number of reasons. It could be that they've got a complex benefit structure that they wish to simplify and make sure that they've got their member records, their data is in the right place so that they can engage an insurer. But as Jon said, a lot of this comes down to the strength of the covenant, and effectively you're moving from one covenant to another covenant, and it's the relative strengths of those two different covenants that the trustees have to assess. whilst focusing really ultimately on the member outcome and ensuring that they have security in the future. So that's largely the consideration that we see. But also, if you're sitting on a surplus, you might have some illiquids in the portfolio that are money good, that might be rolling off over the next 2 or 3 years, and you may wish for those to run off in due course, and you can feed that money back to the members. So there may be lots of reasons why schemes might just want to reflect on their situation before embarking on a particular route.
Yeah, and both of you sort of touched on this, that the core focus is making sure that the members are secure and their pensions are being paid. How would you say the sort of key considerations for a small scheme differ to that of a large scheme?
I think that the challenge is the same, because ultimately this is about ensuring people get the retirements that they deserve. So if that's your goal, if that's your focus, then the question is, how do you best achieve that? If you're a smaller scheme, the governance challenges are perhaps more acute. You don't have necessarily the same resources that a larger scheme might have in terms of the advice and the different people that you might work with, which is one of the reasons we as an organisation have been so focused at the small end. We look after lots and lots of very small pension schemes, and it's really important that they get the same level of access to the insurance market as some of the larger schemes. And I don't know, Jon, if you want to say something about the proposition that we've developed.
Yes, so we've recently relaunched our small scheme proposition, which has got the snazzy name of Flow, and effectively what it's seeking to do, it's an end-to-end proposition. So it takes the scheme from not just to the transaction, but also through the data cleanse to the point of buyout and then into post-sale. And the reason it's set up like that, I suppose, as Mark mentioned, you start with the end in mind. It's all about making sure pensioners get paid the pensions that they deserve, and you work back through the process. And it's not the most straightforward, but we've made it as simple as possible so that trustees at outset can see what they're going to achieve, when things are going to happen, and they get that to and through journey so they can see where they are and what they're getting.
Yeah, I think our listeners might be familiar with this because our last episode covered the relaunch of the Flow proposition. So definitely talking about, getting in touch with the insurer, receiving the quote, and even like the post-sale side of it and how members are going to be looked after and the sort of gold standard we'll achieve on small schemes as well as large.
I think there's a broader consideration that perhaps is worth noting, which is that some schemes think that the end game or the engagement with the insurer is at a point in time set by them. So they will say, well, actually, next September, I want to do the following. And what they perhaps don't appreciate is that if you get ready now, the market can come to you. And the savings that you can make, and therefore the benefit to your members of being able to move when the market allows you to move, can be considerable. So preparation now, having all of your ducks in a row now, actually can be really, really attractive, rather than setting what might be an artificial moment in time 12 months hence. So being ready to act when the market allows you to do so, when is the most attractive from a financial point of view for you, can be really, really appealing. And that's one of the things that we stress to the clients that we work with.
And discuss with them all the time. It's more and more the conversation. If you've worked out how you're going to pay the pensions and you can use Flow to, post-transaction, the discussion then becomes, okay, how do we reach that magical premium target? How do we use our assets? How do we transfer them frictionlessly and on a timely basis so that it meets their target?
Yeah. And how would you say this sort of differs for a larger scheme? Obviously, for the small scheme, we've got the Flow proposition where we're looking at from right at the beginning to right at the end, transacting and post-sale. I guess for larger schemes, they're a bit more complex and have a lot more sort of bespoke solutions that we have to look into.
Yeah, I think we've both had experience of partnering with larger schemes, and I think they have a wider breadth of complexity, potentially a wider and more complex benefit structure, simply by virtue of their size. I think that the customer experience is always a key focus for every scheme, but it simply means that I think we spend more time with the larger ones because they are more complicated.
I think it's important to note that we are one of the few, if the only, whole of market insurer. So the most recent transaction that we announced, I think it was last week, was a £30 million scheme. So we regularly engage at the smaller end, just as we do at the larger end. And I think it's really important that our clients are aware of that.
Right. And, in the busy market, what would you say a scheme needs to do to sort of stand out to insurers?
So, it comes back to preparation and engagement. We've probably said this many times over, but there's a few key elements of an initial discussion that you have with the client, and it's clear that they've taken the time to prepare. And I always think that a well-prepared scheme can probably transact when the time is right for them. So they'll have completed a feasibility study to understand how affordable the transaction might be, and that gives certainty to an insurer that there is going to be a transaction at the end of this. They'll have looked at their benefit specification, as Mark mentioned. Sort of a legally reviewed benefit spec, again, allows the insurer to price the risk more accurately. So any gaps, it creates uncertainty. And that's exactly the same with the data. Data doesn't need to be perfect, but if it's had some level of cleansing, again, it gives the insurer certainty of what they're trying to price. And I think in terms of assets, we've touched on this before, and illiquid assets comes there. Understanding the transferability and the attractiveness of the assets is probably the thing that's going to come out as key, and certainly a lot of client discussions we're having, that seems to be an area of focus with our asset management colleagues around what how this might help them over the next few years if they're not quite there. And then finally, as governance and engagement. If you have clear decision-making criteria, if you have a nimble, flexible decision-making structure, some of the opportunities are quite short-lived. So being able to have that joint working group, the clear lines of communication, means that you can capture opportunities swiftly.
I guess a key point that you mentioned for schemes is assets. What should a pension scheme's asset holdings look like when they approach the insurance market?
Well, it's interesting. If you take a step back and you look at, for example, the new funding code, pension schemes are increasingly adopting what we would call a low dependency model. So that is low dependency on their sponsor. And so that typically means adopting a portfolio that is very much like the portfolios that we manage for our annuitants. That is to say, a basket of fixed income instruments that will deliver the requisite level of cash flows. So many of the schemes that we work with are already on that de-risking journey. And having embarked upon that journey, the consideration is therefore, do you then pass those assets to an insurer, or do you retain them yourselves and run them on for a period of time or potentially in perpetuity? So there are actually a number of parallels now that we see both on the insurance side of the book and on the pension side of the book. The difference between the two might be that some of our pension scheme clients do retain and want to run on for a little while with some of their more illiquid exposures, either to capture the embedded value within those, or to consider whether to pass those to an insurer to sell on into the market, or to find a third party that may wish to acquire them. And that process can take a few months. But there's some really interesting and innovative solutions that the insurance community has been developing to support clients who want to do that.
I guess this is where the sort of engagement with an insurer or partnering really helps, because you can discuss the sort of bespoke solutions with, especially when there are illiquid assets in the portfolio.
Absolutely. The earlier, the better. At Legal & General, we have a team internally that we've built up to help schemes to triage those assets, to consider whether to sell them into the market. In some instances, they may well pass across to the insurer, and the insurer may decide to hold them for a while before disposing of them. So we, as I say, there are some very innovative solutions that the industry has been developing to support clients, acknowledging that post-crisis, many of them had a fairly heavy allocation towards illiquid. So whilst the funding level had improved significantly, they were still left with a considerable basket of assets that typically under Solvency II wouldn't be attractive to an insurer, and they need to understand what they can do with those and what their options are. And many of those are in the money and they want to extract value from them.
That feeds back to the governance structure that we were talking about. It's understanding the attractiveness, the transferability. It allowed one of our clients to reframe their objectives with the sponsor. So it's all about engagement and the ongoing dialogue of what the objectives are.
So one of the questions we're often asked is, well, what do you do with the money? So as Jon's mentioned, part of the premium consideration will typically be a basket of matching assets, typically gilts and corporate credit, occasionally some less liquid strategies that under Solvency II have cash flow characteristics. But what does an insurer then do with the money? And the answer lies in what the government's talking about at the moment, which is clearly a growth agenda looking to level up certain parts of the UK and investing behind a belief that there are some really attractive areas such as housing, transport and infrastructure in the UK where we can use our balance sheet to great effect. Achieving both the security of income that our members need, but also delivering a really positive social outcome. And that's really reflected in L&G's support for the Mansion House Compact 12 months ago.
I think just adding to that, I think the number's something around 30 billion invested across all those different agendas.
I guess you spoke about some assets which insurers wouldn't want. Do you have any examples of assets we might not take on from an insurer perspective, Jon?
I mean, there's a couple of easy ones. Equities, obviously, as Mark mentioned, from a regulatory environment, we have to hold assets that closely match our liabilities, and that includes the fixed income assets, the gilts, corporate bonds, high quality illiquid assets. In terms of illiquid assets that we like, they typically have, we typically like segregated accounts that we can transfer across, and we can have a clear look through and do due diligence on the underlying assets. Where it's in a pooled fund, they're typically not consistent with a sort of regulatory required asset. So what we have to do is find another way of facilitating either that transfer or disposal. And we've had lots of conversations with clients about how to help them do that.
Although one of the things that we're able to do is for those clients that use our pool funds, we're able to novate the units across to our colleagues on the insurance side, which saves quite a lot of time and admin burden for the clients in trying to realize the value of those units whilst they're with us. But we can actually pass the units across on an in-specie basis to the insurance team, and they can then at some later stage dispose of those. So we can actually pass them as part of the premium effectively, which is, I think, a really attractive feature of working closely with the L&G group.
Yeah, it's very niche sort of process that's in place.
I was talking to a client yesterday who was celebrating the fact he hadn't realised that we actually articulate the premium in terms of the asset management funds. So from the moment that you've got exclusivity in a quote, it's essentially anchored to the movement in the LGIM funds and can be transferred. So it's frictionless, no out of market. And he was really pleased with the simplicity and transparency of it all.
And it wasn't that long ago that we did our first transaction with physical property. So a scheme came to us with a portfolio of physical assets, and we decided that some of them would be an attractive addition to the annuity book, and we were able to in-specie those as well. So very much case by case. I think the key is to engage, to look early in the conversation, and to assess what might be attractive to an insurer. I think the one thing we want to avoid is clients feeling that an insurer is not interested in any of their illiquid assets, and to engage in a kind of a fire sale before they've even got to us.
And I guess, obviously, you mentioned that there's lots of activity in the pension risk market. How do you think this will sort of develop in the future?
I mean, I think that there's lots of charts bouncing around in terms of market commentators. The increase in gilt yields and the focus probably on, pension risk transfer for UK PLC means that it's probably going to be elevated levels of engagement for, many years to come. I don't have the numbers off the top of my head, but I think that people are suggesting that the annual baseline of deal volumes has increased from, say, 25 billion a few years ago up to 40 billion going forwards for now.
I think there's a confluence of regulation and markets, which is causing lots of our clients to think about their end game. They're in a position now where they can. The burden of running a pension scheme increases year on year. The cost of running one, the governance of running one, the reporting requirements of running one. And so the consideration now is, well, what do we do for, the short and the medium term? And that's why I think you're going to see an increase in these types of conversations. There's more innovation, as I said earlier, in the insurance market. And particularly at the smaller end, I think there are some really attractive propositions that are available now to our clients. So I would expect us to be ever more busy in this space as schemes want to solve for what is a considerable challenge for many of them, which is what is their long-term priority to secure member benefits.
Great. And I guess on the broader pensions market, how do you think this will continue to develop in the future?
I mean, I think more broadly, benefit provision is shifted from DB to DC, and you can see flickers of CDC arriving, in the wings, TBC. Yeah, I mean, there's always got to be benefit provision for members of companies. It's a fundamental necessity of everybody's HR department. So it's probably going to be more DC than DB going forward.
I think much of it depends on what the forthcoming pensions bill says, if I'm honest. So there'll be all eyes on that in the spring. We don't know what the agenda will be. We've obviously been aware of various consultations that have taken place under the last administration. Some of those may well be carried forward. We don't yet know. So I think all eyes will be on what the announcement is in the spring.
Great, thanks. And I think that was all the questions I had. Are there any sort of ending thoughts that you have that you'd like to share with our listeners?
I think all I would say is that Endgame is a really important consideration. We are here to support our clients, to take them to and through this process. We work very closely with our colleagues on the insurance side of the business, but equally we work with a number of other insurers in the market. I think it's important that we are there to support clients whichever direction they take, whether they choose to talk to an insurer today or whether they wish to defer that for a period so that they can sort out some of the issues that we've outlined. The key is that Legal & General can help them.
Great, thanks. And Jon?
I mean, I'd echo prepare and engage. It's more and more we're having conversations with clients about what to do prior to coming to market. Lots of asset management clients, lots of other clients. So as Mark says, we're here to help, and we've probably got a broad spectrum of offerings that can help people. So please come and talk to us.
Thank you once again, and thank you for tuning in. As Mark and Jon have just said, don't hesitate to reach out to them, and also check out our Endgame Insights Report, which further looks at some of the topics we've discussed today. I'm Roshni Sakaria, and this is the PRT Pod.